Welcome to the Broken Pie Chart Podcast, episode 299. I'm your host, Derek Moore. With me once again is my semi-permanent co-host, more permanent than semi these days, Jay Pestrichelli. All right, Jay, we're back. Market's taking a little breather, but post-election rallies are the norm, according to Twitter, Jay.
All right. So, yeah, you're right. This has been a little bit of a choppy week. Even as we're recording this on Friday, market's legging down again after the euphoria of the election week, I'll call it. But I know it's interesting, this data that you have here, that, you know, it's not out of the normal to see kind of ups and downs after this. And, we've been bullish, I'd say biased a little to the bull side as we've, the last couple of weeks, even months as we talk through this. So I think it's good to kind of, take a look at what the reality is. I will say I was listening to, I listen to whether it's Mad Money with Jim Cramer, Fast Money. Like, I listen to those from time to time. And I think one time this week, Cramer was saying, look, it's fine to sell stocks sometimes. Just take the profit off. It's okay, right? So it was almost like you see a little bit of this bias that, maybe the market run up leading in, and then the market, after the election week was maybe a little over, maybe it overshot it a little bit. It's time to wait to see how some things are going to play out. So I think it's an interesting dynamic. I'm not surprised here. It's hard to pick, the bias week by week. I'm sure we'll talk a little bit about some of our volatility triggers and what they told us is coming this week, right? We had some changes there, right? We had changes before the election. Now we've seen some changes after. So I'll let you help us focus a little on this, the S&P post-presidential elections from election day to the end of the year.
Yeah. And most of the time, the market's up. By the way, the market is up most of the time. We've already talked about that.
Yeah.
Yeah, I mean, really, it's, if you look at Biden, Trump 1, Trump 2 now is up post-election day. But, you look at these, it's like, yeah. I mean, Bush in 2004, yeah, that was maybe flat-ish.
No, I think that one was up. That was up.
Obama 2012, that was the one.
Yeah, Obama 2012.
It was Nixon 68. That was the one.
It was the only one that was down. So really, you're going back to Nixon 68 as kind of the market showing declines after the election day through the end of the year.
But you know what this is, Jay? It's like, okay, the market, I hate to say don't watch CNBC all day, but honestly, like if you watch CNBC for the last couple of weeks, it's like, oh, the election. Okay, the election's done. Now it's like, all right, rates. It's earnings, it's valuations. Jay Powell, the other Jay, said, you know what, maybe we're not in a hurry to raise rates. And the bond market has been sniffing this out.
He's been listening to you, Derek. I think he listens to the podcast.
He probably does. He's probably doing policy based upon that. And the bond market listens as well. And the bond market has been right so far about the changing dynamics of expectations. One of the things we've been watching is post the Fed cut, the 10-year yields are higher, the 2-year yields are higher. And there was a chart from, let's see, this is MRB Partners. The Daily Shot put this out on Twitter. The median, so post Fed easing, 10-year Treasury yields, this is the title of this, buck the typical Fed easing cycle trend. The median is after the Fed starts easing, 10-year yields are down. The range is a little bit up, but I would say it more slants down. This is out of the range. But we've been saying, but for a recession, if you have this, if you're cutting rates and you're not in a recession like 94, 95, 96, yields go up. Yields have gone up. I mean, we've been giving people the example here. Exhibit number 2 is look at the 2-year yields against the Fed funds rate. The 2-year yield sold off, and I would say maybe it sold off too much. And 2-year yields are interesting because they tend to trace the pattern of the Fed funds rate, and they're sort of try and foresee the future a little bit. So, we've been saying for a long time, like, why is everyone thinking they're going to cut to 3%, but for a recession or trouble? I think the bond market has this right.
I don't know about you, but I talked to two different clients this week, and they both are thinking about, but they're buying property, just kind of normal course of buying a house, moving, that kind of stuff. And they've all said, "Well, I'm just going to give it a few more months, and I know rates are going to be lower." And I said, "I don't know how you know that. It doesn't feel like anybody could know that at this point." I'm not sure. Like, there's evidence here that the longer end of the curve will not go down. Yields will not drop. And so it just, I said, look, the market is what the market is right now. That's how the market is being priced. If you think where rates are going to go, then more than what the market is saying, because then the markets would have adjusted. So it's just one of those things. Don't necessarily count on longer term rates associated with with loans that rates will go down. I think it's probably fair to say, if you fast forward a couple of years from now, that's probably the expected trend as everything's getting adjusted. But there's so many things that could change that. But I don't think there's any guarantee at all that rates are lower in 3 months, 6 months from now, especially on the longer end of the curve. There's just not. So,
well, to be right on rates, you have to be right on the direction, right on the market reaction at different points of the curve. And you also have to be right on what's going to be the spread between let's say on a 30-year mortgage, the spread between the 30-year mortgage rate and the 10-year Treasury yield. We've been saying, it's typically historically, let's say about 170 basis points, 1.7%. It's been closer to 3% or 300 basis points. And there's reasons why. I'll bore our entire audience, Jay, if I start getting into, mortgage-backed securities and why or why not, there might be demanding a higher yield right now. But you've got to get a lot of things right. Like, that's the point. CNBC, you sent me an article. CNBC had a post, and this was from Delivering Alpha. CNBC Delivering Alpha. Title is "Buying Bonds When the Federal Reserve Started Cutting Rates Was a Mistake That May Soon Get Bigger." This seems to imply that rates are going higher.
Yeah, bonds will go lower, right? Yeah. And that means rates going higher. I mean, I just thought it was timely. And we always talk about, I don't know how long we've now been talking about this topic. So, the media catches up with you eventually, Derek. Mm-hmm. Eventually.
As they should. Well, I did write the book, Broken Pie Chart, and I have a chapter, Bonds Future Performance Can't Possibly Match Past Performance. And it's the idea that there's no way that bonds are going to match, the post 1982 high all the way down when rates almost, we're under 1% on the 10-year. So yeah, next time I'm on TV, they'll introduce me, the guy who called the bond market, sell off. I'll be like, what's the guy that Dr. Doom who got it right once?
Yeah, you got it right once, and then you get to claim that all the time. But I look, it's okay to finally talk about like bucking the trend a little bit. If we all know the crowd is usually wrong, right? Common knowledge. But by the way, common sense is actually a negative term, right? It is merged, or merged isn't even the right term. It is kind of migrated now to more like, oh, you just know what you should know. But common sense, I guess we don't need to go into the English language too much. It was more about, that's what the common people know, right? That's not what the aristocrats know. So the term common sense ended up changing because it ended up just getting used. It's almost like the word literally. Literally doesn't mean literally anymore, right? Literally and figuratively, it could be either one of those, right? So just the misuse of that. I don't know where I'm going with this, but my point is, again, the crowd is usually wrong. If the crowd feels something, you should absolutely question that, for sure.
Well, maybe not only the crowd, but the institutions. I think the smart and the dumb money.
Oh, they're part of the crowd. Right. Yeah. How many? I love pointing it out. I know, broken record. 27 out of 28 economists predicted a recession in 2023. Right.
That's right.
Didn't happen, everybody. Right. And that was the smartest of them in theory. So,
the bond, the expectations for future Fed rate cuts or not cuts, it changes. It changes every day. We have on Bloomberg, we pull it up, and you have the implied rate. Jay, I don't know if you saw this, but after Powell's comments yesterday, the December 18th meeting has only a 55% probability of one cut.
Where was it before that?
It was not less than one cut.
Right. The odds were, like two cuts. And what did he say yesterday? Right. He said,
we're in no hurry.
We're in no hurry. We're in no hurry to cut. Yeah. Like, again, and by the way, that was kind of music to my ears. I mean, of course, we love it when the market goes up, and the market goes up when they think rates are going to get cut. But, a more measured approach and leaving rates a little higher for longer, is not awful, especially when it's pretty clear. We had CPI and PPI this week. Inflation hasn't been licked yet. I mean, I was it's done. I don't know. It's not at their target of 2%, which they have deliberately said they're not wavering on.
Well, when is it? We talked about that a couple of weeks ago on the show. It's very rarely right about 2% or within, 25 basis points of 2%. But to your point on inflation, headline this is from Bloomberg, U.S. inflation progress stalled in October. And if you look at a chart at it, the CPI month over month has been pretty much the same. And the core CPI month over month has been sort of the same. And it was 0.2%. And 0.2% compounded over 12 months is what? 2.5, 2.6, something like that?
Yeah, that range.
Okay.
You got 24 months, right? 0.2 is not 20, right? Or does yes, in a compound. So it's more than just 12 times. Yes.
More than 12 times, yes. But to your point, inflation's not at 2%. Doesn't need to be 2%. I don't know. It very rarely is right around 2%. I mean, it's been under, it's been over. All right, so this also leads to the dollar. And the dollar index has risen recently. And I like the dollar is one of those things, like if you're bearish and you say, well, the dollar is pushing up against its resistance from, when was that, September of 2023. Sometimes the dollar matters, sometimes it doesn't. And I think if it gets another sort of breakout above the levels we're at now, it starts to get out of the zone. I call it the zone of insignificance, and it starts to matter. And why does it matter? It goes back to earnings, because if the dollar is too high, those earnings from multinational companies, because companies report in dollars, and a strong dollar actually lowers the EPS capture and the revenue capture from overseas sales. Jay, this is something I'm watching, and I feel like I'm one of the only people who watches this, but there's an inverted relationship when the dollar gets out of the quote unquote zone of insignificance, Jay.
I'm gonna zone of insignificance. Is that like when you're in the friend zone and then you're out of the friend zone? I don't know, but so I think that the dollar matters often, right? It's not only an every once in a while thing. So watching that dollar euro almost at parity, right? That's another thing where the euro and the dollar are almost, it's almost 1 for 1. I mean, I think it was like 1.04, 1.05 last time I saw that. So, you haven't heard a lot of talk about it, but you see it reflected in things like gold, right? Where, yes. Because the dollar's getting stronger, it takes less dollars to buy gold. You've seen an absolute retracement in gold since the election, because the theory here is, the America First approach means stronger dollars. This probably leads into a tariff discussion, right? All of those kinds of things. So it ends up, the dollar ends up being stronger. People want dollars instead of other currencies. Anyways, we could go into a lot more detail on this. But yeah, I think watching this, I don't think it's mattered yet, Derek, as we're only just a few percent off all-time highs, right? It's not, we'll see eventually what this impacts in earnings. But countless earnings calls that we've listened to where foreign currency, they call it FX exchange rates, have impacted revenue for even, large caps like Microsoft and Apple. Right.
Well, you remember back in 2022, Microsoft and Apple, to your point, remember they used to say, well, the currency adjusted EPS would have been 9% higher or something like that. Like it eats into the EPS. So, yeah, I think it matters, but you don't like my zone of like there's a certain range, like the dollar doesn't matter. And then it. I don't dislike it. I'm going to digest it. Yeah. Well, it goes back to tariffs. You mentioned tariffs. Now what we're seeing is some charts. This is from the source Macro Bond and Nordea, if I'm pronouncing that right. The Daily Shot put this out on Twitter. What they did was, your favorite, Jay, they traced the US CPI 1970 chart, and then they overlaid where we are today based upon the point. So this is what, 24 months in? This isn't really labeled good.
No, and not to mention, you got two different scales. One goes from 2 to 15, the other 0 to 10, and they're curve fitting it. But I get it. So what they're trying to do here is show commonality in the rise of inflation in the 70s and the decline of inflation in the 70s compared to what we just went through.
And we're in the valley. We're sort of at a trough.
What is the x-axis there? Months? Like, what do you think that is? Years?
I have no idea.
I don't even know what that is.
Yeah.
It's really a chart crime. Let's put it in that category. However, there is something here to watch, that in this particular instance where they grabbed, a period of high inflation and they can map it in a way similar to what we just experienced, this is indicating, if this was to follow through, that, hey, inflation, can pop to be even higher than it was before.
Well, it goes back to the tariff. You mentioned tariffs, and there's this thought now that if tariffs are implemented, and I have some thoughts on tariffs, but I want to hear what you say first. But this is one of the things, like, tariffs are coming, and the stuff that has tariffs on it is going to go up in price. Is that kind of, I mean, that's the theory. That's what everybody's saying. I think you and I, unfortunately, are going to be on the same side of this, so there won't be much of an argument. But go ahead. Well, I would say if tariffs are such a bad idea, well, first of all, I think one of the reasons why Trump wants to use tariffs is that he wants to put a tariff on to force the tariffs to go off, because there are tariffs around the world. But by the way, if tariffs were such a bad idea, we've had tariffs on sugar since like the 1800s. I don't know if you're aware of this, but there are...
I'm aware that I like sugar. That's what I'm aware of.
It would be a lot cheaper, but for tariffs. We have tariffs that protect U.S. sugar. And this is the Cato Institute, and I'll put a link to this. It has sort of the history of tariffs and everything there. But to give you an example, any sugar imported beyond the quota, so there's quotas of how much can come into the U.S., is subject to a tariff of 15.3 cents per pound for raw cane sugar and 16.21 cents per pound for refined sugar. To put this into context, the world price of refined sugar, this is in 2017, fluctuated between 17 cents and 25 cents per pound. So I checked on Bloomberg, it's about 21 cents and change right now. If tariffs are such a bad idea, why have we had tariffs on stuff to protect U.S. Producers since like the 1800s? I'm tired of the media being lazy about this. Like, we have tariffs. We should take off the sugar tariffs. And by the way, when you have sugar tariffs, if it would have been cheaper, that's probably why we went to some of the artificial stuff. All right, Jay, back to you.
There might be a health piece in there too, by the way. Heard a discussion about Skittles this morning. All right. So I think look, you could make a very good argument here that tariffs were not inflationary in 2016. I think they caused quite a bit of volatility in the market. And I understand logistically why it's, hey, you're going to pay more. Those tariffs means you have to buy, either you're buying American or the tariffs get passed through. And you're going to pay more because, everything's just going to kind of go up. But we didn't really see that. It's more of a behavior piece. I do think it's questionable that tariffs will pay for things like, tax cuts or entitlements, right? I don't think those, that you can't tax your way, you can't tariff your way into offsetting your spending habits. But I don't know. Well, I don't know if that will be the thing that's really inflationary. I mean, but according to that chart that we talked about here, we're in the valley between two mountains, and we'll see what happens.
But this argument was there a year ago before Trump got reelected. Like remember, this goes into the thing of the people who are always calling for market crashes, or we're going to see a double dip or double rise in inflation like we had in the 70s. I don't know. We could. We might not. I don't know. People should understand. Isn't there like a maple syrup tariff? Like if we try and sell our syrup to Canada, isn't there like a 200% tariff on that?
I don't know.
Countries do this. By the way, tariffs are dumb. I'm against tariffs. Like countries should be able to do free trade. If you can make it cheaper, you should be able to do it. And then there's also things that go into, okay, what about national security? What about, we need domestic production. There's all sorts of things. But I think it's lazy by the media to just talking about tariffs. And yeah.
Don't you think if the government thought they were inflationary, they would have been removed with the Inflationary Act of the current and exiting administration, right? Didn't they try to do a bunch of things?
Left them on.
But they left them all on. Right. That's the point I'm making. They left them all on, and they deliberately tried to reduce inflation. I'm not sure that thing was mislabeled, but they were trying to reduce inflation. They were, it seems, not so successful. But wouldn't you think to include this if they were so inflationary, but yet they were not? They were excluded out of that act. I don't know. So
sure,
yeah,
sure. Right. I mean, we'll watch this. I'll put a link to the history of sugar tariffs again since the 1800s.
That is a long time.
On. Yeah, isn't there? There's like all right. I don't want to go down the path of tariffs. Let's talk about what do we want to go to next. Let's go. Okay. Valuations. So I don't know if you were aware of this, Jay, but our forward PE is 23.35 times forward earnings. So, okay.
Historically, that's high.
It's high. Sure, it's high. And Daily Shot put this out. The S&P 500 risk premium, which is the forward earnings yield minus the 10-year Treasury yield, has turned negative for the first time. Jay, give me a moment just to explain the earnings yield. So the forward estimate for EPS for the S&P 500 is $254.83. When I did this calculation on my piece of paper here, the market was at 58.86. You take the 254.83 divided by the 58.86, you get 4.33. That's the earnings yield. It's your earnings into your stock price or your index price. We're about 4.48% on the 10-year. And so what they've done here is they show a chart and they say, okay, we haven't had the earnings yield below the 10-year Treasury yield since 2002. Is this bullish or bearish or I don't know. I mean, 2002 was the end of the bear market, right?
Pretty bad year, right?
Yeah. I mean, 2001, 2002, this is screaming, we're going into a recession immediately, right, Jay?
That's what there's, well, I don't know about recession, but
you want to scare some people? Let's scare some people. Let's talk about that.
Overvalue of the market, right? Yeah. I mean, that's what we're really talking about. Again, I will also say, we've talked about this multiple times, the recession and the stock market do not walk hand in hand. Usually the market is ahead of a recession by what? 6 months, a year, right? By the time they actually figure out that we're in one. And so as we're pressing to new highs, it tells me there's not a recession around the corner. The fastest one I saw was the pandemic, where the market was completely caught off guard on that recession. That was really not very predictable. Although some would tell you it was, but maybe let's not go down that path.
The yield curve inverted in 2019, right? So,
because it randomly inverted. They knew the pandemic was coming. Yeah, I know.
By the way, let me just take a step back too. Like, I think a couple people have said, hey, you guys have been overly bullish, so I want to scare some people today. And I say that sarcastically because we want to give both sides, but this is why we hedge. Like, generally markets go up over time. We know that. Just look at a chart. We have hedges, we have buffers, we have different strategies that may not do the same thing as the market. They can offer non-correlated opportunities there. By the way, if you want to learn more about this stuff, Derek.Moore at ZegaInvestments.com. That's DEREK.MOORE at Z as in zebra, E as in Eddie, G as in George, A as in Apple. Investments is up to you to spell correctly if you want to email me. Email questions too. We like answering listener questions. But all right, so this is really a value type argument though. And I would say that, yeah, 23 times and change forward earnings is, I mean, that's higher than 21. The earnings could go up.
Somebody should write that one down. 23 is higher than 21. That's good.
21. I got that in my notes. But, Jay, what can happen? The E can go up.
Well, right, the earnings, meaning the earnings you don't really know what the earnings are going to be. They're projected earnings, right? What actually happens versus this forward earnings projection doesn't necessarily, tell you, if we are or aren't overvalued. I think you could, look, people track it because it's meant to give you some sort of foresight into, hey, is there going to be a cheaper time to buy this market? The thing is, companies can catch up on earnings, but like you said, we don't know how, what happens day to day. And I just gave some advice to somebody, which was like, look, anything can happen in a 6-month period, right? They were talking about, hey, I've got some cash. I need to sit on it for 6 months. Again, it was a mortgage question, right? I think they're buying property. And my advice was, look, in 6 months, you don't know what can happen. If you told me you had that money and you're going to sit on it for a year or a year and a half, okay, makes sense to invest it, hedge it. You don't want to lose your buying power. But 6 months is such a long period of time. Anything can happen. And so when you look at things like this, you got to have a bad earnings season, which I don't believe we just had, but we're in the middle of. Are we through it? Are we through most of the S&P earnings at this point, Derek?
Oh, not really.
I mean, there might be a big one coming up soon. I don't know. Maybe if you want to.
Who's that coming up?
Who is that? Nvidia on the 20th. Anyway, but generally, right, I think earnings have been strong. So, but you don't know when that can get reversed. And I think the fundamental investors that used information on company profits and earnings will probably be very quick to sell. You probably also see a rotation into value, which, by the way, has done some catching up right over the last couple weeks to growth. So a lot of moving dynamics on this, Derek. I appreciate pointing out the PE ratio, and you almost feel silly ignoring it because you ignore it at your own peril. So, it's a data point that you should keep in mind. If you have all this optimism, there's plenty of reasons to have skepticism.
Yep. No, that's right. Price to sales is something I watch. And where are we on price to sales? We're about 3.09 right now. And November of 21, we got up to 3.23 price to sales. But that's trailing. That's not forward. So
yeah.
All right. By the way, do you think Nvidia, as goes the market in the short term? Like, that's a pretty big earnings report.
I mean, it will. Part of the market, definitely the chip sector and the tech sector, it'll pull it one way or another. It's such a big component now, and it is really one of those outliers in my mind that make this time a little different than last time.
Don't do it. Boy.
Look, all I'm going to say is in 2016, if you follow that playbook, which the market right now is kind of following, right? You saw small caps outperform. You saw large tech underperform after the 2016 election. So the thing here is I do think between a different emerging asset class. Oh, I called it an asset class. Between crypto and AI, I think you have a little different story now. And, it has been, it is, I mean, I don't think there's any doubt that it was the driving factor of growth in 2023, led by Nvidia. I don't think the AI story is even close to over. Like, you listen to all of the large tech companies, they talked about their investments in AI, right, and how much it's costing them. And that's, why maybe there were some concerns about capital spending, CapEx. But I think the point that I'm bringing up on this is AI might make this time a little different. And as NVIDIA goes, so does the AI story.
Well, it goes to productivity too. I mean, if AI can make even, an old line chemical company, it's like now we have the internet and we're an old line chemical company, and now we have Excel, and now we have AI. AI can make them more productive, and you get more productivity out of your existing structure. That goes to margins. and margins continuing to be high, or maybe AI can help them go higher. We don't know yet. That would be the bull case for AI. And then there's all the spend that happens with these companies as well. I mean, we know that CapEx is going up, and I mean, in some ways, they're all just giving CapEx to each other. That's going back and forth. But,
right. But I mean, I think you've made this case like, hey, if Google, Alphabet, Microsoft, and Apple are spending money on AI investments, they're probably spending it with companies that specialize in AI, right? Like Nvidia. So,
and by the way, analysts much smarter than you and I who follow nothing but Nvidia give forward earnings guidance and projections.
Yeah.
So the question is, I think it is going to Nvidia. The question is it already priced in, or is it more than we thought, the analysts thought, or less than we thought?
I mean, Nvidia is just off of an all-time high again this past week, right? So, yeah, I mean, so look, people could be getting ahead of that. We'll see.
Sure.
I don't know what Nvidia is going to do. I don't have a theory on what's going to happen.
I'll let you know next Friday.
Yeah, we'll let you know. Yeah, I can tell you what the options are doing on Nvidia, but besides that, there you go.
Well, actually, let's take a small detour there. What's the implied volatility on the?
I don't know on it. You got to give me a second to pull it up, Derek. I told you I was a little hampered today.
I got it. Hang on. I was throwing it to you, but I'll throw it back.
I told you I ain't got it today. I'll get it.
So I'm going to look at the November 22nd option chain. That's 7 days out, and the at the money is right around 80 implied vol.
So it's a little lower than past earnings periods. What's the straddle tell us? Sorry, what is the kind of the break even option trade? What's implied in the option pricing, right? So if you look at say there are 143s. Now I'm actually looking on my phone. 13-point move. It's not a big move, right? That means if you bought the call and you bought the put right now for next Friday, by the way, this is probably going to go up. In that,
of course,
as you get closer.
It's going to change.
But if you bought those two now, right, your break even is either 130 on the downside, you'll make money on that trade, or 156 on the upside, right, at about $13 baked in there. That's not even a 10% move as the stock is at 140. So now it's early. The general expectation is that straddle costs will go up as we approach the 20th.
By the way, if you sold the straddle today, the covered return, so the annualized return, basically what you get.
If you could do it every like a week, right? Because it's like 7.
And assuming they both expire worthless, which that would mean pinning right at 143. It's like 400% annualized return. Don't do this trade, by the way.
No, we're definitely not suggesting get short a straddle on Nvidia.
Yeah, good luck with that one.
No,
you're a daisy if you do on that one, man. That's all right. I want to talk about. I can't believe I'm doing this again. I got to do it. Bitcoin, Jay, and
90 over 92,000 at one point this week. I don't know where it is this second.
Well, yes, thank you. I have banned that symbol or whatever symbol that is from my
really
list. Yeah, I don't follow Bitcoin.
Let me ask you a question. Is there a price where you would buy Bitcoin? Would you buy it at 50,000?
I probably should have bought it at 100 in hindsight. I don't know how I would have bought it back then. For like $1. That would have been good.
That would have been great. Would you buy it if it went to 5,000? If you saw Bitcoin 5,000, would Derek Moore buy it?
No, because that means it's broken. That means, you know what I mean? Like when it breaks, it breaks. Like
so 20,000? Would you buy it at 20,000 then? Because it hasn't broken yet?
As a technical trader, and I don't know where I would buy it. I'm just hypothetically saying, like the way to buy it is when it breaks out. As a technician, if it goes all the way back down, it's like, think about the Outlier rookie card back in the late 80s, 90s for the Yankees. Like it went up to $100 and it came back down to whatever it came back. That's not the time to buy it because it's over. The bubble's over, I don't know. But let me refocus this. I want to talk about Michael Saylor, and because you've got you're the Bitcoin expert on this call for sure.
Between the two of us, fine. If someone has to be, I'll take it. Go ahead.
Yeah. So Michael Saylor is doing a leveraged Bitcoin play where he's offering convertible bonds and then they buy more Bitcoin. Barron's had a piece, and in their article, and I'll link to it, the company's Bitcoin stake, 279,420 coins, is now worth about $24 billion based on the current Bitcoin price, while the company's market capitalization is nearly $72 billion based on 210 million basic shares outstanding. So basically what they're saying is the company is trading at a premium to its Bitcoin stake. So like if you're just going to buy Bitcoin, you could buy the Bitcoin, or you could buy MicroStrategies. And the reason why this is, like, imagine, Jay, you and I had XYZ company, fantastic company, by the way, and totally fake company. And all we owned was like one desk, and the desk was worth $100. Well, if that company gets dissolved and we sold the desk, we get $100 for it. Like that's sort of the breakup value, or the whatever you call that. So it's trading at a premium. So I don't know. Barron's thought this was interesting.
Well, all right. Look, if you're trying to say the value of MicroStrategy should be closer tied to the value of, I don't know why you're bringing up the value of its Bitcoin holding. Obviously, that's the thing pushing the stock price. It right now is, I would say, there's a frenzy. I mean, we see it in some of the ETFs that we manage. There is a frenzy of trading volume, actually to the point that it's actually causing some structural challenges. And I won't go into the details of what market makers and custodians can hold and broker rules, but there is absolutely a pressing against the envelope of what the market, how much more the market can handle in trading volume and holdings on companies like MicroStrategy and Coinbase. So there's I think it's interesting to I'm sharing this dynamic because most average folks wouldn't see this if they weren't involved in the day-to-day trading of like the underlying options within these tickers. What I would tell you, Derek, is we just finished talking about forward earnings and multiples, right? Mm-hmm. Why not apply a multiple to this company like any other, asset, right? I mean, when you look at, I'm not making the bull case for MicroStrategy. I'm definitely not doing that. I'm just saying, just to say the value of the company should be, only tied to the Bitcoin holdings. Heck, the market is a forward-looking vehicle, right? If you're a Bitcoin bull, you don't think Bitcoin stops at 92,000, right? If you're Michael Saylor, you think Bitcoin, again, I've heard him say this, Bitcoin is worth 5 million a coin in the future, right? Like these numbers are astronomical. So that's what this valuation is all about. And also you have this really, I'm going to say, a trading frenzy. It is very much, it feels like the frenzy we saw around the meme stocks in 2021, right? It feels a lot like that. Like I've got, teenagers of clients calling me and saying, "Hey, I want to buy some of this MicroStrategy. What do you think?" And I'm like, "Okay, buy it along with your Dogecoin." But and I'm not bashing MicroStrategy. I don't know where that stock is going to go. There's an upside, there's a downside to this, but right now it is the hot hand. And like anything that has added volatility, I mean, I think the volatility, let's not get into the options on it too much. But the point is, there is just this frenzy of trading associated with the success of MicroStrategy. Everybody wants to hear what Michael Saylor has to say right now. He was at a crypto conference in Miami this week. When he's on TV, they lead him in hours ahead of his time that he's going to be on, right? Because I know it'll keep people on, right? He's definitely got the hot hand. Everybody's very, very interested in what Michael Saylor at MicroStrategy has to say today. I think congratulations to him taking the risk and being on the forefront of this. How it'll shake out, not sure. But he's got conviction, and his theory of, Bitcoin as a store of value is a component of change.
I'm going to get emails. I definitely will get emails talking about Michael Saylor and Bitcoin. The Barron's article, by the way, he said the premium is close to 3.5, Barron's estimates. This is when Bitcoin was in the 80,000 range. It says means investors effectively are paying about $250,000 for each of the company's Bitcoin. I mean, I haven't taken the time to look at their sheet. Like it sounds like, investors, to your point about forward Ps and their leverage Bitcoin strategy, maybe the investors feel like he can buy Bitcoin and the way he's doing it is more optimal. It is interesting though. Like, you remember back in the day when we started in the business, and I think I started a couple of years before you, like price to book was a big deal. And price to book was like, oh, I have a factory and I have these trucks and I have this equipment. And so if I were to sell all this equipment,
if I liquidated my assets, right? What's my value compared to that? Right.
That's right. No, and it's like that used to be a big deal. That was a big thing with, the Benjamin Graham investors, who, and by the way, I think Jason Zweig rewrites that book. Is it The Intelligent Investor? The Benjamin Graham book?
I'm not sure. I think you're right. That sounds right.
Yeah, I think he rewrites the forward and rearranges it and things like that. Like, he's even said in his research that Graham acknowledged that what he was able to do when stocks were trading below book value back in the day isn't really the case anymore. And we've, even some of the Magnificent Seven, like the tech stocks, price to book doesn't work because they don't, like, Instagram doesn't really own a factory. They had, it started with 10 guys in a room. And so I don't know where I'm going with this.
I think it's a little different. I think let's get back to the idea of, look, this is a fundamental approach evaluating stocks. And, if you're someone that looks for strong fundamentals and making decisions, you would have never bought a Tesla or Amazon type stock. Now there's some of the biggest in the world, and you'd find yourself going, okay, I guess I got to stick with Exxon and things like that, a little more older school economy. I don't know which way is right, which way is wrong. In different environments, they perform differently. I don't want it to seem like we're whistling past the graveyard. Like, yeah, thanks. I'm going to call it E.F. Hutton, whatever you had to say. I'm just trying to come up with an old school.
Speaks, everyone listens.
People listen, right? I was just kind of coming up with somebody, Smith Barney, right? Like those kinds of I'll say older focused types value investing approaches, just they don't work in the go-go tech explosion. And you just have to be comfortable missing out on explosive gains for speculative stocks. There's always a speculative aspect to stock investing. So you manage the amount you put towards that. You want a more stable portfolio? Fine. It all depends what you're trying to gain here. But I think folks that like to, make a name and poo-poo something that obviously has a ton of momentum is a way just to get, to get eyeballs, right? It's clickbait. Barron's usually, I like the publication, right? But, to tell people you're really paying $250,000 for each Bitcoin that MicroStrategy owns. That's not the point, right? You could have been in and out of MicroStrategy multiple times in the past week and been successful or lost money. Don't know. Hard to time a stock that moves 10% intraday every day. It's difficult trading. But the point is they're appealing to the wrong investor, right? It's like telling people, I'm sure there's a great analogy here, but the people that are buying and trading MicroStrategy right now are not the people that give a darn about the fundamentals behind the company, generally speaking. So what I would say is, look, I know people should care about it and should care about the long-term investment case, and that's fun. That's not what's happening in the stock right now. Look at the last 7 months of the stock chart. That's clearly not fundamental investors. That is momentum trading. That is technical trading, regardless of the price of Bitcoin. So, I'm poo-pooing Barron's on even putting this out because no one's listening, dude. If that's the way you think, you didn't buy MicroStrategy anyway.
This appeals to the people who didn't buy MicroStrategy when it was much lower.
Yeah, so you feel better that you didn't. Hey, I feel better.
See, I told you.
Yeah.
By the way, it goes back to you hate when I say it. More buyers than sellers, stock goes up. When there's more sellers than buyers, stock goes down. More buyers than sellers, stock goes up.
That is absolutely the case here. And I would tell you that, and I mentioned a little bit earlier about the institutions, the issue that's going on with options. They're, in a way, again, like the short squeeze we saw in GameStop, and they made a movie about it. Maybe not the short squeeze part. But they made a movie about how much institutions are forced to react when retail moves. That is definitely the case that's happening here, especially with options and MicroStrategy.
All right. Before we wrap up, Sam Rowe had tweeted out what the street's 2024 S&P 500 price targets were as of December 3, 2023. Where are we right now? 58, right? Above 5,800, right?
Right around there, yeah.
Okay. Thanks to Sam for tweeting this out. So December 3rd, 2023, JP Morgan, 4,200 target. Morgan Stanley, 4,500. UBS, 4,600. Wells Fargo, 4,625. Goldman, 4,700. 4,750, Societe Generale. Barclays, 4,800. BofA, 5,000. 5,100, BMO Deutsche Bank. 5,500, Capital Economics. We are at 5,800. I bring this up because nobody knows anything.
Nobody knows. People that spend millions and millions, hundreds, tens of millions of dollars on research and to help their investors still can't get it right because there's so many factors. It's unpredictable. It's why we hedge, but we also want to have exposure to growth. Markets generally go up. We like that trend. Yeah. Stay invested. Hedge yourself if you're worried about it. Manage the hedges. Don't try to time the market.
Yeah, I mean, JP Morgan's only off by 1,600. I think I'll be off less than JP Morgan this year. I've been off more than JP Morgan other years, but all right, we'll get to that's coming up, Jay. Our December show. We go through the targets. All right, Jay. Any recommendations this week?
Watch the show, a good show on Netflix called The Diplomat. Second season just finished up. Like the first season, really like the second season. I'm a strong buy on The Diplomat.
I'm going to issue a strong buy. Jay, actually, my wife and I went to the movies. Imagine that.
Wait, like in a theater?
In a theater.
What did it cost you? $150 to get popcorn and a soda? I'm kidding. I love going to the movies, so I go whenever there's anything that can pique my interest.
It was $33 it was a quote unquote matinee because it was before 5, I think. Yeah. We're old. We go $33 for the two of us. Anyway, there's no inflation, right? There's no inflation.
What are you going to quote when you were like 18 and you go to the movies and it was $4 a ticket? Is that what you think?
Yeah, that's right. All right. So anyway, I'm a strong buy on Juror Number 2, Jay. It's Clint Eastwood directed it. And you really don't see these types of movies anymore released. Nowadays, it's all superheroes and that type of stuff. The premise is a guy winds up on a jury, and the case is this girl had been in a bar with her boyfriend. She winds up, walking off, and then found in a ditch. Blunt force trauma. This guy's on a jury, and he's listening to it, and he realizes, oh, I drove home from the same bar a year ago, and I thought I hit a deer. What if it wasn't a deer? Pretty good premise. I'll leave it there.
Okay, Juror Number 2.
Yeah, I think people should go see this in the movies. And I read up on it. Warner Brothers, I guess, isn't even doing any advertising. Come on.
Yeah, I didn't even know it was out. And is Clint Eastwood really? Okay.
Clint Eastwood directed it. He wasn't in it.
No. That's probably better. I mean, is he in his 90s at this point? Gosh,
he's 94, I think.
Yeah.
His last movie was Cry Macho, I think. That was the last one he was in.
I did cry when I watched that one. Disappointment.
Good. Yeah. So anyway, Juror Number 2. Strong buy. Go see it.
Well, watch The Diplomat at home. You don't have to go into a movie theater for it.
Yeah. Diplomat at home, Juror Number 2 in the theater. I think Juror Number 2 is going to be on HBO Max in a month anyway. But so there you go. All right, Jay. That's it. We aptly bearish enough? Were we bearish enough this week?
Yeah, hopefully. Right. Not all markets. What's the phrase I heard a lot this week? Markets don't go rise to the sky. Trees don't grow to the sky. Is that how's that phrase go? Right.
I don't know.
Yeah. All right. Never mind. Certainly reasons for and look, it's in. But yep, I'm going to leave it there. You're right. Sentiment is not as bullish this week as last week. Let's leave it there.
Send emails. We love answering listener questions. And thanks again to our Chilean listeners. See you, Jay.
Bye, Derek.